thought it would make sense to do a brief video on the current state of the hard money lending space. There seems to be a lot of confusion out there, who's lending, who's not lending, why they're not lending. And I thought it makes sense to kind of go through my thoughts on the current market. You know, we're dealing with a pandemic. My hair is getting longer by the day, and I can't do anything about it. And I think it's such an uncertain time in the space for everybody that I figured I'd just clear up a few things. So the first thing that I want to address and really clear up is why your hard money lender, the one you knew that was lending 6 weeks ago, 8 weeks ago, isn't lending anymore. In fact, 9 out of 10 hard money lenders aren't lending. And the real reason for that is because they never had funds to lend to begin with. They weren't lending their own money. They were going to private equity shops, to Wall Street, to hedge funds, and they were using these aggregators, as I call them, to fund all of their deals. So what they would do is they would close your loan on a Wednesday, and on a Friday, they would sell their loan off to an aggregator who then would take a pool of loans and securitize them, mortgage-backed securities. And that's a business that really emerged out of the Great Recession because banks stopped lending, liquidity tightened up. And so when I was out buying hundreds of houses and I had capital, I was well capitalized, I was able to buy houses cash with the backing of my company. I was competing with folks that either had cash or they had the benefit of knowing a hard money lender. So what happened is Wall Street saw the opportunity. They want to get scale. They can't go out and buy houses one by one, but they wanted to invest in the space. So what they did is they fueled this huge growth in the number of hard money lenders. I'm in Boston. I see it all the time. These lenders would pop up out of nowhere. They used to be brokers. They all of a sudden formed a shop who would, because they had a client base, they had some ability to lend. They would take the characteristics of the private lending aggregator, and they would say, okay, we have a program, and they would get a loan, they would close it. Oftentimes they'd use their line of credit that they got from a bank, and then on 2 or 3 days later, they'd sell it off to the aggregator. So when the aggregator stops buying loans because they can no longer sell or securitize pools of their loans, they stop buying them from the underlying lender, and then the lender's money dries up. So who's left? Me. I'm a balance sheet lender. I have millions of dollars in the bank, and quite honestly, the only hard money lenders out there lending right now are ones with their own funds. They're the only ones that can lend. So what are the rules? What are the new guidelines by which I'm willing to make a loan in the hard money space? It's not that simple. To me, in fact, it goes back to the good old days of hard money lending. Every deal is looked at on a case-by-case basis. No two deals are alike. The idea that you could create a box, and as long as you meet the metrics, you fund it, especially in New England, especially in the greater Boston market, where street to street can vary dramatically. It just never made any sense to me. So as a balance sheet lender right now, I'm looking at the market. How resilient was it in the Great Recession? How liquid of a market is it? I'm targeting low LTVs. I'm looking at 60% LTV on an as-complete basis as my target. I simply don't believe in the values of the last 6, 9 months, 12 months. I'm looking at what the future value is going to be. And not just in the sense of what it's going to be worth when it's complete and looking at the trailing comp set. I'm looking at it, what it might look like in terms of the end sale value if instead of 20 buyers showing up, maybe only 1 or 2. Maybe it turns into a buyer's market quickly. The only thing going for the market right now is the fact that the inventory is low. The fact is, markets don't plummet overnight. If you look at the Great Recession and you look at peak to trough, you see it takes 5 or 6 years. It might have been 05, 06 at the peak, and it might be 12, 13 at the trough. So there will be buyers all the way down, and we know that, and that's why we're still lending. But at the end of the day, I'm going to be focused on the market. I'm going to be looking at the improvements. Are they attractive? I'm going to be looking at a lot of things that maybe other lenders didn't look at too closely in the last 6, 12, 9 months. But that's what I'm going to be focused on. I'm going to be using loan to cost. Am I going to be looking at a max 85% loan to cost like I did 6 weeks ago? No. But am I going to be targeting 30% down, 40% down? I don't know. It's all going to be dependent on the deal itself, what I feel the opportunity is, how the deal is priced. Is it being purchased at what I feel is a distressed level. All of these things matter, and no two deals are the same. So I'm going to be looking at all of these things, and we're going to be very picky about the deals we do and the deals we don't. But the good news is we're closing loans when others are not.